The Bank of England's base rate is currently sitting at a historic low of 0.1%, following two emergency rate cuts during the COVID-19 pandemic, designed to help keep the economy afloat, even during strict periods of national lockdown. However, the rate cuts were always intended to be temporary, and concerns are mounting that the Bank of England may begin to raise its base rate again in the near future to help stifle rising inflation, which recently overtook the bank's own target of 2%. But let's get back to basics first. The Bank of England's base rate is set by the institution's committee called the Monetary Policy Committee. Usually on the first or second Thursday of the month, the committee meets and announces if there have been any changes to the existing base rate. The meeting is also recorded and published for investors to analyse if there are any indications that the committee intends to make any changes in the future and what the attitudes of each of the members is about the current economic climate. For example, they would be able to see from the meeting minutes who out of all 9 members voted for interest rates to go up, go down, or stay the same. Now, the current basis on which the base rate is generally decided depends on a range of economic indicators, which are used to determine the health of the UK economy and if a rate change is necessary. Now, as we navigate the ongoing pandemic and focus turns to the economic recovery, there have been several indications that a base rate hike may be necessary to quell inflation before it spirals out of the bank's control. First of all, inflation surged well beyond the bank's intended 2% target, reaching 2.5% over the summer, although it has since slipped back to 2%. In effect, this means that the cost of living is going up, and the bank has suggested that it expects inflation to continue to rise as high as 4% by the end of the year. Even though this inflationary surge is only expected to be temporary, there are still concerns that it could get out of hand, and the bank may have to intervene earlier than it had intended, which was previously chalked for 2023. However, even with rising inflation figures, other things that we need to be aware of are unemployment rates. And these have been falling steadily, and it now sits at 4.78% after 182,000 new employees joined the workforce between June and July. Now, the bank could use this indicator as a sign that the economy is recovering from the economic slump caused by the pandemic and therefore look to raise interest rates sooner rather than later. Interestingly, UK economic growth forecasts are being increased from initial estimates. Back in February, the Bank of England had predicted the UK economy would grow by 5%, but they've now changed that figure for it to be 7.25% for the year 2021, which would be the highest annual rate in 75 years. Now, the bank's 2022 forecast are also higher at 6%, indicating that it anticipates the economic recovery to carry on for well into next year. All of this provides the right kind of environment for the Bank of England to seriously consider raising the base rate again. However, support for a rate hike is still very low. At every meeting since the initial rate cuts, the committee has unanimously voted to keep the base rate at its current level of 0.1%. Although some senior members have indicated that they believe the bank may have to adjust rates sooner than intended, many analysts now expect the bank to not raise interest rates until the beginning of 2022 and then only to 0.25%.